Well, when you're selling a business, you're focused on that number for the sale of the
Yeah.
business, but you don't get into the weeds. I get into the weeds, and I'm not trying to brag, but you learn how to get into the weeds because you realize that things happen.
Yeah.
And so you had these things happen. I've been doing this over 30 years. I still learn. I still learn to this day where things come up that you don't expect.
Welcome to P&L, Priorities and Lifestyle, with your host, Rob Schultz. Rob is the founder and president of Schultz Wealth. All opinions expressed by Rob and his guests are solely their own opinions and do not reflect the opinion of Schultz Wealth Limited. This podcast is for informational purposes only and should not be relied upon for investment decisions. Please refer to our website for more information.
Welcome everybody to P&L, Priorities and Lifestyle. I'm your host, Rob Schultz, and today, Pete, we have a repeat. So we did this April of last year. I went back and looked. It was a great session, and you and I think were at lunch, the other week, whatever. It's like, hey, let's do this again. And you actually agreed to it, so you must have had fun.
I always have fun.
Yeah. Ladies and gentlemen, Pete Benenati. Pete has a law firm here in Bedford, Texas. With how many lawyers do you have?
Oh, you also have to make me think about that. 1, 2, 3, 4, and probably going to hire a fifth one before the end of the year.
He's got a team out of his firm here. Been doing this for a while. Not from around here. Pete is a New Yorker. He's a transplant. Long time ago, though. How long have you been in the great state of Texas?
I've been in the great state of Texas over 30 years now.
Yeah.
More than half my life.
Did all of your education up there, though?
Absolutely.
Let's see, King's College?
Queens College.
Queens College, yeah.
King's College would be Brooklyn.
Okay.
And then Syracuse, proud alum of the Orange, and then NYU for my master's in tax.
Yeah. And came down here, and you've been working with business owners primarily, I believe, just like we do. I think that's why we just keep running into each other.
I think so.
Yeah. Yeah. Well, thanks for being on the show again.
Happy to be here.
Yeah, we had a good discussion last go around. We did the whole gamut because as an attorney, you work just in areas where we just seem to connect constantly, whether it's estate planning, whether it's business planning, transactions, things like that. What am I missing? Compensation. I want to talk about that today. Yeah.
And not to mention the real estate as well as executive comp, as you said, compensation. So it runs the gamut. We don't do litigation in the firm. We don't do ERISA, even though I used to be an ERISA lawyer way back 30 years ago.
I didn't know that.
Oh, yeah. But, with custom plans aren't the thing anymore. Everything's a safe harbor. So, it became not really, unless you were doing them all the time, not worth doing. And then we don't do immigration. And we don't do divorce, though. We do marital agreements, but we don't do divorce.
Okay. Well, I would consider marital agreements, and I like that term better than the prenup term, right? It's an agreement.
It's an agreement.
It can be before or after marriage, right? It's a marital agreement. That's kind of part of your estate planning,
It is. And before we get into everything else, you made me think. Second marriages, the prenup is not about divorce. Everybody else thinks the prenup is about divorce. It really isn't. No. In second marriages, it's about death and not having to deal with the kids of the deceased spouse by creating community property or claims on it. So in second marriages, it really is about making sure we avoid conflicts with children of each marriage for the surviving spouse. That's just a little sidebar.
You know what? And you and I may not agree on everything, but I 100%. Because basically the way I see them, and I think the way you do them, I mean, it's just basically, what's yours, what's mine, and that's going to come into play when somebody dies for sure. And you can go back to that agreement and you can say, okay, well, I can see very plainly this agreement between the two of you as to who owns what and what's going to go to who at death, and makes it so much easier.
It does, and you don't want the conflict with the children of the deceased spouse, and that helps a lot. And we do a lot of those, and we haven't had conflicts because they do spell out the rules.
Yeah, they do. All right, let's talk about deals.
Sure.
I'm a little bit surprised. Deal flow's been good. Interest rates are up. There's obviously they're a little bit tougher, but we still see transactions happening. You're seeing transactions happening.
We're probably going to close over 40 deals this year.
Yeah.
At the pace we're going. Deals have not slowed down. Prices may have adjusted just a wee bit here or there, or they may be looking harder a little bit more, the due diligence, where they're questioning accounts receivable, where they're questioning cash flow. We're seeing a lot more QVs, quality of earnings, on even the small deals. I'm having a client who's buying a business for about $1 million valuation, but is having a quality of earnings done, just to be sure.
No kidding.
Oh yeah, and that's about that one. The fee quote was 20 to 25,000. So if you're thinking about somebody willing to invest that on $1 million purchase, they're important. When the financials are not reviewed, when the financials are not audited, or they're not kept in accordance with GAAP, because small business owners tend to sometimes maybe fudge some things.
Yeah, yeah. Well, so yeah, that makes sense to me because it's just a little tighter. I think due to interest rates primarily, and so there's less room for fluff, and I can see that. So from the standpoint of everybody kind of dotting their I's, crossing their T's a little bit more, we were talking like right before we started the role here. What were we talking about? We were talking about working capital.
We
Yeah,
were.
so you've had a couple of deals here recently where that's become a little bit of an issue, maybe.
Yeah, and so for the folks who are listening who don't understand the working capital, when you sell a business, you're selling a business as a going concern. So there's something known as multiple of EBITDA, which we talked about last time. And I don't want to get into the weeds on that, but part of that is what's known as a certain level of working capital being left in the business.
Right.
Traditionally, the average trailing 12-month working capital, excluding cash, excluding long term debt. So, what is that on a monthly basis? So, basically, AR reduced by payables or short term debt on a monthly basis. And that should be a relatively easy number to come up with.
It's a mathematical number. Yeah.
But we still negotiate it
Right.
and try to get it down for if I'm representing a seller, I want that as low as possible, because that becomes target working capital. That's the amount you have to leave in the business. If that's the amount you have to leave in the business, then anything above that is yours, the seller.
Yeah, cash free, debt free. Yeah.
So, but then target working capital is the goal. Then there's closing working capital, which is estimated. What do you think the working capital is on the closing date? And then traditionally within 60 to 90 days, the buyers have the ability to provide their assessment of what the final closing working capital was. And if it's more than the target working capital, buyer owes seller. If it's less than the working capital, seller owes buyer.
We call this a true up.
It's a true up.
Yeah.
Correct. And so I've had two deals recently where one came back with over $1 million they claimed the seller owed the buyer. And that took the buyer took almost a year to get those numbers to us and kept asking for extensions. And then we got those numbers, and then I had to hire a different CPA because the company CPA wasn't able to handle it, to negotiate back, because they were taking certain tax positions that were not consistent with what we had been doing. And and they tried to change the methodology of how to calculate closing working capital, but from what we presented in a schedule. So we actually knew this was going to be an issue in this deal, and we had a schedule of how we calculated it, and they wanted to change it. It's taken 6 months since they presented that. We just received this week the the agreement that there is no adjustment to working capital. All escrow money will be released. Convenient enough, I sold another business to the same buyer, and now we got their working capital calculation, which took them 6 months to get to us, and it's off by about 900,000. Now on this one, they were right about some of the changes. There's about 300,000 my client will owe the buyer, but there's 600,000 that we know is not quite right, and some assessments they did, and they're approaching an item that's not consistent with what was presented. So we'll have to negotiate that. So knowing your working capital, knowing your numbers at closing are very important, because you will have to true them up at times, and sometimes the swing's big.
Yeah, no question. So this concept of working capital, one of the things that comes up kind of at a basic level, I was just thinking of it because we have a client together. This came up one time a few years ago. Is if you're an S corp and you've left cash in the business, you've paid taxes on that.
Correct.
And a lot of times the seller will say, "Well, I've paid taxes on that. Isn't that mine?"
Yeah. And a lot of times we will get that cash kept. We'll keep that cash a lot of times because it's cash free, debt free. So the cash is not considered in working capital.
Okay.
If not, as you said, you used the phrase cash free, debt free. You'll see that in LOIs all the time. Well, that means the cash doesn't go to the buyer. Now, you may have to leave cash in the business sometimes if the target working capital is 100,000 and your AR less your payables is 70,000,
Yeah.
then you got to leave
You got to
30,000 in
leave it.
cash.
Yeah.
But the other 70,000, let's say there's 100,000 cash, is yours. But cash belongs to the seller.
Mhm.
That's why you say cash free, debt free. And every so often I have to we will actually we have this on two different deals we just closed. We had to leave a certain amount of cash in the business, okay, as a condition. Now that was going to be part of the working capital calculation, but we had to leave cash. The buyer wanted cash, having cash available to pay the bills as soon as they bought the business. And so that is part of the working capital. So we will have an adjustment to purchase price, which means we'll get to keep more AR, accounts receivable, or something. But sometimes buyers want to see cash left in the business, which is fine if it's part of the deal, as long as they don't want it as a addition, so to speak,
Yeah, I got you.
without an
As long
additional
as we're doing
purchase
it
price.
based upon this working capital calculation that
Correct.
everybody
So
agrees on.
So in
Okay.
this particular deal, we added $225,000 to the seller financing, and my client said they would be willing to do that. And we have a subordinated security interest, which is not as good as a first lien security interest,
Sure.
but at least we're ahead of any other unsecured creditors. And in that deal, the buyer tried to have us give up our security interest, which I had specifically negotiated in the LOI for a reason. I know first lien creditors don't like it. And in this one, it was private debt that was funding this, not a bank. And I made sure I said, no, we keep our security interest. They were like, well, we have no other debt. I said, for now.
For now, it can always change. Yeah, absolutely.
I said, I don't want to be lumped in with the other unsecured creditors. If you go bad, fine. At least I have second position. We have something we can do. So there are all little fine lines of what you're doing there, which I'm going to jump you because the other thing you wanted to talk about was rollover investment, which leads to another way to get compensated in a sale, right? You got
Yeah.
seller financing. You got to make sure you have your loan, good loan terms, default terms, subordinated security interest, and if you can get a personal guarantee or life insurance on the buyers.
Sure.
It depends who's buying. But then there's a lot of buyers who are larger companies and not necessarily publicly traded because they don't have an interest necessarily doing that, but larger companies who are looking to grow and keep people vested in the help of growing that. So they will offer equity in the buying entity.
Yeah, we see it all the time.
Right. And people think since they don't get cash, that equity is not taxable when received. Well, it's no different than a barter system. You receive $100,000 of stock for a $100,000 value of your company. That's taxable unless you structure it the right way. And if you don't structure it the right way, you're going to pay tax. And most people don't like paying tax on something they didn't get cash for.
Yeah. Well, because you got to come up with the cash for the tax.
You have to come up with the cash. We had a deal right now. We had no choice because of the what the company was and what we were getting. We couldn't do a rollover, tax deferred rollover. So my client knew it. We negotiated an additional purchase price to help cover that tax.
Okay.
But traditionally, you're going to try to roll over. Let's say it's 20% they ask you to reinvest, and you want to. You think they're going to grow this.
Absolutely.
Next 3 to 5 years, they're going to take it 8 times, right? What they bought you for. And so now you get that second bite of the apple. Now, I'm going to say what I say to every seller.
I know what you're going to say.
Only thing you can depend on is the cash you get at closing.
That's right.
So if that cash is not enough to make you happy, don't do the deal because you don't know if this is going to work out. Now, I will say more than 80% of my transactions have worked out, but that still leaves 20%.
It still leaves 20%. Yeah.
Okay. So that greed factor, I call it.
And I'll let me leave a caveat to that. Yeah. Okay. So 80% of them will work out, but not all of those will work out in the same way that you anticipated.
Right.
Because we're seeing a lot of recaps right now and other deals. Instead of an actual second roll, it's a different type of transaction, or maybe it's taking a little bit longer than anticipated.
Correct.
Okay.
That's a good point. Really good point. And so the last thing we want to do is pay tax on something that you might not
get. Yes.
And then it's a capital loss that you get to take at $3,000 a year, unless you have a significant capital gain somewhere else. So we want to structure it as a rollover, tax deferred rollover, and we actually spell that out in LOIs as well. And by the way, I keep saying LOIs, letter of intent, and also known as a term sheet, depending what people want to do. And the way you do that is one of two ways. If the entity buying is a partnership, then it's easy. We contribute, if we're selling 80% of the assets, and we then contribute 20% of the assets to that entity for the equity in that entity, taxed as a partnership. That is automatically treated as a 751 contribution for that equity. You get tax deferred treatment, and your basis is the basis of your assets here, which are low.
And that's regardless of what your structure is as a buyer going in, whether you're an S corp or an LLC or C.
Correct.
Okay.
It is. If you're a C, then that equity will be owned by that C corp and still subject to that double tax. So you'll pay tax at the C corp level when it finally cashes out, and then you'll pay tax when you take that cash out of the C corp. But if you take that equity out of the C corp before it's turned to cash, you have a taxable transaction as a dividend. And then the corporation is treated as recognizing that gain as though it got cash. And then you're paying tax as though you received cash. So you don't want to take that equity distribution out of a C corp if you get a rollover equity. You just got to sit there. By the way, you got to do the same thing with an S corp. If you're selling assets of an S corp, by the way, S corp is a tax treatment, everyone. Everybody else thinks it's an entity. It's not. It's a tax status. So whether you have an LLC taxed as an S corp, you have a corporation taxed as an S corp. If it's treated as an S corp, filing an 1120S, if you take a distribution of that rollover equity, the S corp has to recognize it as though it got cash if you distribute it out. You have gain at the S corp level. Then you take your distribution, no tax, because
it's flow through.
It's a flow through entity, one level of tax, but you're paying tax as though you received cash if you take a distribution from the S corp. So anytime you do a rollover into an S corp or a C corp, you have to keep that rollover investment in the entity, and that investment has to stay there until
it goes. Okay.
Unless you feel like paying tax.
As long as you do that, then you don't have to pay the tax until it actually
if you're investing in a partnership.
So this is for sure an asset purchase. Then.
It's an asset purchase. If it's an equity purchase, it's not so hard, right? If an equity purchase, we just keep out 20% equity here.
Yeah, you didn't sell it. Yeah.
Okay.
It's deferred.
Now, if on the other hand, this entity is a C corp, then we have to do something different. I'm not going to get into the weeds about it, but it's known as a drop-down LLC, where we keep 20% of our LLC and we sell 80% of the LLC.
So you have to be an LLC to be able to do that?
Well,
or do you become one?
Well, the thing is that they don't want the liability, so we drop down to a brand new entity, and we call it a drop-down LLC. And then that LLC that now owns all the assets sells 80% over.
But is there a transaction between, let's say...
It's a contribution, which is tax-free, because it's the parent company contributing to a subsidiary, let's say.
So you can do that during transaction?
Yeah, we have where this LLC, the start is a disregarded entity. Then we sell 80% of it over to the entity, the buying entity, and we recognize our gain there. That 20%, on the other hand, stays here, and we never sold it. And so now we segregated the liability from the big company to the small company, so the buyer is not recognizing it. And then this turns into a partnership tax treatment, and the buyer then gets to make a 754 election to take a step up in basis on the assets acquired. It's deemed an asset acquisition for that 80%, so the buyer still gets their tax deduction.
So basically, you need a really good lawyer to do a transaction and minimize your taxes.
There are just different ways you structure things that you need to know.
This starts, and it gets much more complicated than even what you just described there. I'm sure a lot of people's heads are spinning a little bit.
Absolutely.
But it's so important because, like you said, I think you said it really well when you said, hey, it's would not be fun to have to pay taxes now on something that may not even come to fruition, right? And then, like you said, just write it off from now till eternity at $3,000 a year. Nobody's going to be happy with that.
No, the deal we
So
just closed Friday had much more complexity. We had to roll up several different of the companies that were being acquired into a new holding company, and that holding company then formed an LLC that we sold 80% over because of the rollover investment. So sometimes you need multiple transactions,
oh yeah,
and so I don't want to get into the weeds on it because it does get complicated, as you can tell. But there are ways to do most things to get tax deferral if you want.
yeah, yeah.
And something else people should know, we're talking about the rollover investment. Be aware that if you have a promissory note that's more than $5 million in your seller financing, there's a penalty.
Like a tax penalty?
Yeah, they're basically going to charge you a tax on the tax deferral you're taking on an installment obligation if it's more than $5 million. And I'm not going to get into the weeds on that, but I'll wager most people don't realize that.
Yeah, until they have to pay it.
It's only if it's more than $5 million. And so a lot of I'm sorry to say to small businesses,
Sure.
they've referred to small businesses less than 30 million.
Yeah.
The big firms will refer to anything less than 100 million. Those are nice sales, but those are traditionally small businesses where we're not going to take more than $5 million
Right.
in installment sales. But if you get to 50, 60, 70, now you got an issue on installment obligations. Now you got an issue on that potential penalty that the IRS is charging. It came out maybe 6, 7 years ago.
Really?
It doesn't get a lot of press, but it's out there.
Well, and that's important because that's another deferral. On an installment sale, you don't have to pay taxes on the gain until you actually receive the payment on that note.
So then you got to run the analysis. Do I decide to accelerate my gain on my installment obligation and recognize it all in the year of sale, which means I'm paying tax on money I haven't yet received and may not,
right?
Which again becomes a capital loss at $3,000 a year,
Yeah.
or pay the penalty.
Right.
And you just have to run the analysis and the numbers and decide what your
yeah.
buyer is and how much confidence you have in the buyer paying their note.
Awesome. Let's circle back around. I had a question I wanted to ask when we were talking about working capital and all that kind of stuff. It kind of came to mind because this comes up. So you're wanting to sell your business and you just closed like a really big transaction. So and this is a really big deal. Now you're not going to get paid on it. It's not going to get paid on until like 6 months later when the new company that's taken over actually does what they need to do and so forth to be able to make that happen. But it's not in your trading 12 or anything like that. It's now a nice little bump, and you want to get paid on that. You want to get paid on that by the seller. I know that becomes a sticking issue because I've heard it from both sides. I'll hear a seller say, "Well, that's real money. I need to get compensated for that." Then I'll hear the buyer say, "Well, I still have to make good on it. They still have to pay it. I still have to be able to provide the product or whatever it may be." It's like, no, I'm discounting that. How do you work? Have you ever seen anything like that?
Yeah, I'm going to bring up this one's back in 2007.
Okay.
Yeah, 2007. We're selling a company to a publicly traded company. And a lot of times you have what's known as, since this date, you've had no material changes to certain things. One of which a lot of times is you have not received notice from any customer, traditionally it's a threshold level, that they are planning to cancel their work with you or stop working with you. So in the midst of these negotiations, a significant customer, my client, gave notice that they might be making a change. Might. Not that they would.
This is kind of the reverse of my example. Okay, this is good.
And so automatically, we had to notify my client. I said, we have to. I'm sorry, we have to. You do not. Disclosure is how we deal with this. You don't decide to not disclose it.
Yeah.
And so we disclosed it, and the buyer wanted to automatically adjust the purchase price as though that money went away. And remember, we talked about multiple of EBITDA just briefly. We
Sure.
talked about it in more detail last time. That was going to be an effective change to the purchase price.
Absolutely.
I went back and said, whoa, it was a might. And so what we did was we negotiated, and we negotiated because they're paying a multiple of EBITDA based on a year.
Yeah.
So we negotiated if this customer did not cancel their agreement within 6 months of the closing date, then this money that we put in escrow, the multiple of EBITDA associated with that, would come to my client.
So basically you can solve these problems with two ways. One through negotiation, obviously, and secondly through some type of escrow agreement where after all the dust settles, see where you are and split up the winnings.
My client was very happy because the customer canceled 8 months after closing.
Oh my gosh. Oh my gosh.
He took me out to a very nice dinner, me and my wife. He says, I have to thank you for that. And they've stayed really good friends. We just saw them. They've become good friends.
Yeah.
The other way that you're thinking about is what's known as an earnout or a version of an earnout. So if we know we have one strong, if we have one strong customer that we believe is about to provide a significant cash flow, and I have this deal right now, we're negotiating it. If this comes to fruition, this contract, we're going to get the best way to describe it is a commission on it.
Yeah.
And if it comes in, and no different than if they were paying a commission to a salesperson who brought this person in, except it happens to be my client.
I've seen it that way before on an earnout. It's basically a commission.
Or if we believe there's going to be a real bump, then there's an earnout. So we have this right now, 2 deals I did this with. Same buyer, same industry. I do a lot in this industry, but starting the month after closing for the next 12 months, if the EBITDA increases, because we expect it to increase over the EBITDA at closing date, and we start the month after closing because that first month is all transition, then we're going to get a multiple of, it's not the match of the same multiple we were getting at closing, but it's close. So if we were getting 4.8 at closing, we're getting 4 multiple on that bump that we see coming in over the course of the next year because of this buyer coming in and what we're going to be able to do. And the buyer wants this industry and is buying up these businesses. I probably have sold 4 businesses to this buyer this year.
Oh, wow. That's awesome. Okay. So earnout, we'll go circle back around, same as a roll. Make sure that the money that you're receiving at closing is sufficient.
Without a doubt.
And, because I would say on an earnout, it's a much lower percentage than the 80%. It is. It's all over the place.
It is. And it depends how much it is, right?
Yeah.
So even with an earnout, you don't want it to be an all or nothing. So a lot of times what we'll negotiate is if we reach this level, whatever that number is, that threshold, at least trigger, then we'll get a prorated earnout up to the max of what we can get. And so so that way it's not an all or nothing. Right? Heads you win, tails they lose kind of thing. It's if we hit this threshold, which we have to hit a threshold. You hit that, then you're going to get a part of your earnout. You don't hit that, you get no earnout. And then you cap it. So in your industry, a collar.
Yeah, could be. I was thinking interpolated is a term. You're not hitting hard break points. Where it's this or nothing, like you said. It's where it's more fair that way.
So more than anything else, everything is negotiable. It's just a matter of willing buyer, willing sellers, and how much somebody wants you.
I'm loving this conversation. Let's stay on transactions. Let's talk about compensation after the sale. So a lot of times you're going to stay on, and now you're not an owner, you're an employee. Okay. And I've seen this in LOIs before where I go, oh yeah, this all looks great. And then I look at what the comp is going to be. They're going to be tied up, need to be there for 3 years or whatever it may be. And I look and I go, ooh, that doesn't seem fair to me, the compensation that you're receiving. What do you see and what's your advice with regard to negotiating the compensation piece if you're staying on as an employee?
Well, and I hate law school cliches, but I'm going to use one. Okay. It's a double-edged sword. And I'm going to discuss the double-edged sword, not just there, but when the seller owns the real estate too. Remember I mentioned multiple of EBITDA.
Yeah.
So if you're pulling out $125,000 salary currently before sale, but
Correct.
then you say, well, I want 250 now that I'm going to be an
So
employee,
it should affect your
it will
EBITDA.
affect
They're going to use the
EBITDA
250 instead of the one. Yeah.
without a doubt. So if
Okay.
you're getting a 5 multiple and you're getting a 3-year contract, are you willing to take 125 for 3 years because you're getting a 5 on that extra 125 at closing?
Can't get both.
You
Yeah.
can't get both
Okay.
because we're selling on multiple of EBITDA. So it's the other one that I think I mentioned the last time was I have sellers who go, well, you get to add back my salary to EBITDA. So I get a higher price. And I'm like, are you working in the business? Yes. Are you doing significant work in the business? Yes. If you're not there, would somebody else have to do that job? Yes. Well, then your salary stays in.
Mm-hmm.
If you're really just pulling let's say in family businesses, again, we have certain people on the payroll that really won't need to be replaced if this sale happens.
Yeah.
Then that compensation we could add back. But it's my primary, whether it's the man or the woman, both of them think the same way. Add back my salary. Are you doing work in the business that somebody else would have to do? Yes. Then we need, what salary would you have to pay that person? So if you're getting paid too much, we could add back that differential, that delta. But if you're getting paid too little, we have to actually reduce EBITDA. And the buyers are smart. They will know that
they'll know that.
because that's why they're running those numbers. So you got to think about what you want in compensation. And my goal is always getting my clients the same compensation, but I negotiated in the LOI terms for that compensation. So where you're saying it's not fair, you guys stay for 3 years. They don't have to stay for 3 years. They were allowed to quit.
Yeah.
Okay. Now I did have a deal where my buyer wanted the seller to stay and had $500,000 in escrow that said if he left before 2 years, he would surrender that escrow.
I've seen that.
Okay. After a year, we negotiated an amount that would go to him from the escrow because he couldn't
take
not,
it. And that happens a lot. But you know what's happened here recently? I don't know. I'm really lucky. I think a lot of my clients are just super talented, and they've sold their businesses, and their role has actually expanded with the buyer. You know, they've become like a critical part of the team. You know, on more of a national scale and so forth.
Absolutely.
I've got one client that he's in 3 or 4 states now. Really leading the charge with regard to recruiting and as well as just making sure that these acquisitions that they do, that the team is all pulling oars in the same direction, having tons of fun. And he had to renegotiate the compensation
Sure.
after the deal to be able to do that. Another client that smaller company, call it $150 million company, and sold to a $2 billion company. They are looking at making him president of the $2 billion company. So it's a whole new negotiation, obviously.
Absolutely.
But also tied into that one, and interestingly, is an earnout piece, and accelerating that and negotiating that, as well as the potential compensation for becoming president of this $2 billion closely held company.
Closely held.
Yeah.
Okay, so then you're going to want your equity grants. Your options. You're going to want your severance.
Mm-hmm.
Okay, and I negotiate this in LOIs because when you're representing, again, I don't care what kind of business it's in, is if part of the consideration is your compensation and you're considering that as part of your compensation, then I want severance, and I'll negotiate that in the LOI.
Yeah.
And that severance will be if it's a 3-year contract, if they're terminated prior to a year without cause, or they terminate for good reason, and I'll come back to that definition.
Okay.
Then they get 2-year severance. If it's after 1 year, they get 9 months or 6 months severance. But I want to make sure they get a good portion of that contract and they're not let go when that client's thinking they're going to get that cash flow for a period of time. And in negotiating severance, it's not just the base pay that you're looking at. You're looking at a prorated bonus if there was a bonus structure there for the year of termination. And during that severance period, you want the company to reimburse you for your COBRA cost.
Okay. Yeah.
And that one people don't automatically think about, but that's money.
Yeah.
That's money.
It's real money. Yeah.
And so you want that, and we usually negotiate that in the LOI because then I have it in writing. And I'll come back to one comment there, but But if you leave it after the LOI is signed, it's not in writing. It's another big issue of negotiation. If it's important to my seller, then it becomes a harder negotiation. But if we do it here at the LOI level, then everybody's more agreeable. And I've had to go back to LOIs repeatedly when all of a sudden terms want to change. And I said, okay, fine. You want to renegotiate, but understand it's in the LOI. And people respect LOIs. And that's where I was going to say, people always say it's non-binding, the LOI. Absolutely, it's non-binding.
But it
You've
is an
agreed.
agreement.
It is an agreement in the sense of what we're going to do. So when all of a sudden my seller tells me, well, it's non-binding, I said, okay, but you agree to this. What does the buyer think if you all of a sudden want to start renegotiating without a basis for renegotiation? And a lot of times we do have basis for renegotiation, and we will. And buyers are reasonable people. People always think the buyers are just looking for everything. It's a deal. It's no different than in baseball. You have arbitration, right? And they got to figure out how to love each other after arbitration. But each side's presenting their case as to why the owners have to pay less or the player deserves more. Well, in buying and selling your businesses, it's everybody cares about the money. I don't care if that $2 billion company cares about another $50,000 or
Absolutely.
not.
Absolutely. Yeah.
Okay, that's how they made their money. And so you always want to get those things in writing. And so now the other thing to think about is good reason. Okay. So I represent some executives in publicly traded companies, and one of which, when an acquisition happened, my client was a co-president was named with my client who was president.
Okay.
That triggered good reason. Change in role and responsibilities. He
Sure.
no longer had sole role and responsibility. He had co-role and responsibility. We triggered the provision that said good reason to terminate. Now that the buyer, the employer still has a chance to cure that. In this case, they didn't. But I had one time. We triggered the good reason. We sent the notification, and the publicly traded company goes, "Okay, you're right." And my client goes, "So what do I do now?" I said, "You stay. I can't get you to severance. They've corrected the problem." And they were laying off several executives that I represented in this particular company, and for this particular employee, they didn't want to pay him severance, so they fixed the problem.
How about that?
I also had one where we triggered good reason because the person my client was reporting to was changed. It was a level below who she was originally reporting to. That triggered good reason. So good reason matters. If they ask you to move a certain distance from where your home is,
Yeah.
that's a good reason. If they change your role and responsibility, that's a good reason. If they cut your salary, that's a good reason. So
I
there's
think this
lots of
is
things.
good because, obviously these business owners, LOIs, things like that. But, the true compensation agreements probably don't get reviewed enough, from an attorney standpoint.
Well, when you're selling a business, you're focused on that number for the sale of
Yeah.
the business, but you don't get into the weeds. I get into the weeds, and I'm not trying to brag, but you learn how to get into the weeds because you realize that things happen.
Yeah.
And so you had these things happen. I've been doing this over 30 years. I still learn. I still learn to this day where things come up that you don't expect.
So one of the things that came up in my mind when we were talking about compensation, closely held company, this case, for instance, the one I'm talking about, the $2 billion company. So it's privately held. So generally, usually somebody's being compensated at a president level at that, probably only 45% of their compensation is base. The
That's
rest
right.
of it's going to be incentive. It's either going to be a combination of bonus or if it was a public company, it would be stock options. But in a closely held company, it's going to be more what I call phantom stock, right? It's going to be, hey, so the valuation's X. If I get it to Y, then I get
Appreciation.
I get
right,
a stock
valuation
appreciation based upon the
or
valuation.
if it's a partnership, it's known as a profits interest. But yes.
Right. So, boy, that's got to be structured right too. Make sure that everybody understands how you're doing the valuation, et cetera.
Yeah, good luck on that $2 billion company. And I don't mean to be rude in that regard, but odds are the formula says, or the LLC agreement, if it's an LLC partnership agreement, or the stock shareholders agreement, if it's a corporation, will say that upon termination of employment, the company has a right to buy back that employee's interests. And the valuation is determined by the board in a reasonable manner. And unless you have a reason to challenge their calculation, and if you do and you lose, you pay, it's going to be as they determine, applying consistent history and determination by them. Now, you're not going to get that changed, not on a $2 billion company.
Right. So is what it is.
So you have to rely on the board having a fiduciary obligation to its shareholders and its owners to do the right thing and not be Enron.
So there's really not a good way in that situation to hold somebody's feet to the fire on a certain valuation level. It'd be very
not
tough.
with what they already have in place. Now, if you're starting out with a smaller one, you could decide to have a separately negotiated agreement about how that valuation will be determined, which I've done on smaller companies,
Mhm.
100 million and down, where we'll say the valuation is based on this multiple of EBITDA. What's not going to be included in that calculation of EBITDA, which is the oversight fee, or the oversight fee is going to be capped at a certain amount. So it's not just standard EBITDA. You got to then think about what you want included in that EBITDA calculation or not,
Mhm.
right? There's the standard definition, but then you could artificially change that EBITDA calculation. So when we're doing EBITDA calculations on an earnout, we'll say that the oversight fee is not included, because a lot of times a venture capitalist buying it has an oversight fee to the parent company of some sort for overseeing that business, and it tends to be anywhere between 6 and 10% a lot of times.
I didn't know that.
Yeah, and so you'll see that, and I had one where they specifically told me there is no oversight fee. I said, okay, great. I still want to make sure there's no oversight fee, but thank you for pointing that out.
Yeah.
And so we had that formula on the EBITDA to make sure that we didn't have expenses come in that were not true expenses of the business being bought, that were artificial all of a sudden added, such as an oversight fee or a management fee being paid to the parent company.
Okay.
Direct expenses, fine, but we
Yeah.
don't want those artificial oversight expenses. So even that you have to think about.
So oversight fee is kind of like a franchise fee or something.
Kind of, in some ways.
It's just like here you go, you're paying this,
And they're paying bills,
and there's a real cost. Yeah, I can.
but
see
that's
that.
why we want direct expenses. So remember, I came back about the compensation, right?
Yeah.
And increasing it, and it's affecting EBITDA. If I have a client that owns the real estate and then they say, well, I'm below market rent, I said, great. Again, how much are you getting paid on a multiple? Do you really want to increase your rent and have that affect your purchase price?
Squeezing different parts of the balloon, pretty much.
And again, if you're getting a multiple of 7 and your initial term is 5 years, you're going to take the 7 multiple and take the lesser rent. That simple. And then for your renewal periods, you'll get your bumps.
So look at the whole deal.
You have to look at the.
You got to look at the whole deal.
You can't just look at an individual number, because, there was an old movie with Jim Belushi, Mr. Destiny, and had Michael Caine in it. And he said, all of a sudden you do this and your whole trajectory changes. Well, you change this, it affects every other number somewhere else.
Sure. Yeah.
So you gotta focus. And again, it's not gross numbers. You can't even focus on that. You got to focus on net numbers. What is it in your pocket after you're paying taxes and expenses? Gross numbers don't mean anything if all of a sudden you're paying double tax because you're a C Corp.
Yeah.
So if you're selling a C Corp, if you're a C Corp, and we've had to do this, buyers want assets. Primarily because they want a tax deduction. Second, they don't want taking on all the history and risk of the business they're buying.
Yeah, we talked about that last go around. Yeah.
So that's always a concern. So now you're selling assets of a C Corp, double tax. If my seller does not have a non-compete with his company or her company, I could seek to get an appraisal on what their personal goodwill is worth in relation to this business. And without it, how does it affect the value of this business? So then I sell this personal goodwill over to the buyer, reducing the purchase price for the assets of the business, allocating a portion of it to personal goodwill. Personal goodwill is a capital gain asset, 20%, not even subject to affordable healthcare tax of 3.8. I sell that over to the business. The business gets the same 15-year depreciation as it would with business goodwill. My client has one level of tax. In the C Corp, I'm hoping I have AR that I'm also selling maybe, so I have basis in that. If I'm selling inventory, I have basis in that because you can't deduct inventory until it's sold. So at least I'm only paying one level of tax on that money. So you're trying to play these.
So you do a
I,
stock. So
you do an asset.
you do so you change it to a stock purchase.
No, you're still doing an
It's still an
asset,
asset purchase, but
but
you
we're
pull the
apportioning a
goodwill out.
portion of price to the personal
Okay.
goodwill.
All right.
I
Okay.
once had an appraiser give me a 65% overall value for my seller's personal goodwill. I said, "No, I'm going to go get a different appraiser." It was a little too aggressive, and my
Yeah.
client said, "Really, Pete?" I said, "It's too aggressive."
Yeah.
We got a second appraisal. He agreed. He paid for it. We got a 40% on the personal goodwill. That's
That
reasonable.
was reasonable.
65%, I'm playing an audit lottery. And I told my client, it's an audit
Yeah.
lottery. And if that gets audited, you're going to have double tax issues. You're going to have penalties. You're going to have interest. You're going to get hammered. So if you want to play that game, go for it.
And they're
And
going
he
to look
goes,
at
oh,
all of
no.
it. Yeah. No. I don't know.
So there are different ways to skin a cat on taxes, right? Just because you're a C Corp, there are other things you could try to do to reduce that tax hit.
Gotcha. All right, so we're getting towards the end, and I promised you that we would talk about estate tax a little bit because we've got a little bit of a deadline coming up. Of course, it's a legislative thing, so you never know what's going to happen, but we all need to get our minds set on this because we're less than a year and a half away, right?
Yeah.
So let's talk about it.
Yeah, so everybody kind of knows about the estate tax exemption or has read about it or something like that. I always have to point out that President Obama gave us the best estate tax law we've ever had. So when the President Trump increase of the estate tax exemption to 10 million index for inflation, that was doubled President Obama's $5 million exemption index for inflation. So when President Trump got that law passed, it was only for 10 years. So it's not like we lose everything of the estate tax. We're only losing half the exemption. And I know only, but right now it's about 14 million, it's a little less than 14 million, but we anticipate the estate tax exemption coming January 1st, 2026 to be somewhere in the $7.2 to $7.3 million per person, as opposed to the $14.5 million per person.
Because we're counting on Congress not doing anything.
I just don't see how we have this
sunset.
So regardless of which candidate wins, and let's just presume the presumption is former President Trump and President Biden. President Biden's not going to keep the exemption high.
No.
That's not his incentive. He was looking to reduce the exemption amount there in 2021. So he's not going to decide to push to have